Hi, this is Randy Finney with the right side of the chart. Today is Tuesday, July 12th, 2016. In case you missed it, I'm back from vacation now. I've been on vacation for the last week or so and spent the better part of the day catching up on the charts as well as questions in the trading room, private messages, emails, and such. So hopefully I'll be fully caught up tonight, but I wanted to get this video out hopefully before the close today. It's about 2:22 p.m. Eastern time right now, so we have about a little more than an hour and a half before the close as I'm starting this video, and there are enough significant technical developments that warrant a video versus a static post. I wanted to go over a few things. Let's just dive right into the charts and talk about what's happened and what I'm seeing here. This is the S&P, or the SPY, the S&P 500 tracking ETF. And as unless you're living in a cave, we've all heard the SPY has broken out to new all-time highs. So you really, on face value, you can't take that as anything but bullish. And I won't try to dismiss that. I'm going to go over why I have my concerns, why I'm not going long or really overly concerned about, or in other words, let me say this. I expect there's a good chance this breakout will fail. I'll make the case for that here. But it may not, and we have to watch that. We have the rest of the markets, or some of the other more important indexes are at pretty solid and significant resistance levels right now. Now the SPY is the only significant or relevant index that's broken out. The Dow means nothing to me. The Dow is 30 stocks. You don't see me cover the Dow in my analysis. I never have. It is just a compilation of 30 stocks. That's not representative of the stock market or the U.S. economy. SPY, you have 500, the 500 largest companies. So that's a little better. NASDAQ, you have your, this is, the NASDAQ has been the leading index for years now, and those are a lot of the very, very important, some of the biggest companies in the world are in the NASDAQ. So I put a lot of my weighting and focus into NASDAQ. I like to watch the small caps, the mid caps, and the S&P 500. And when I do my analysis, I take them all into consideration. What I'm trying to say here is the SPY has broken out to new highs, but the rest of the indexes have not. So one out of, the four main ones that I cover, the 4 or 5, including the Wilshire 5000, have yet to do so. So that gives me pause number one. If they all break out to new highs, then more power to you. We're probably going up, but we're still quite a ways from it on some of those, like the small caps. So let's take a look here and see what's happened. The other thing giving me pause is this breakout so far today, and as I said, now we have just about a little over an hour and a half to go. We've traded about 62 million shares today, right here, against a 90-day average volume of just over 100 million, very much below average. And again, breakouts that occur on less than 1.5 times or better volume are much more likely to fail. There's yesterday's volume was just nearly as low. We haven't finished today, so this volume bar is still building, but we had very low volume on Monday here. And Friday we had decent volume, I'll give it that. It was above average. That was, let's see here, where's the volume? 134. So it was only about, it was about 34% above average. Not what I want to see on a breakout, but more importantly, the follow-through has been very lackluster. And that gives me concern. The other thing, two other things to mention on the breakout on the SPY, as well as all the major indices right now. This high, today's high, is it's a divergent high, and let's talk on that. I spent a lot of time on Sunday's video covering the past history of divergent lows and highs, so I'm not going to get into that right now, but in just about every case out there, over the last 2 years, as I showed, each of those divergent highs or low were followed by, in the case of divergent high, a correction. In the case of divergent low, a reversal. And downtrend ended, and we had a rally. And when I say rally or correction, I'm talking swing tradable trend changes. In other words, this is a daily chart. When you see me put up a 5 or 15-minute chart, maybe even a 60-minute chart, those are trades, if those patterns trigger or those breakouts trigger, that might last for hours or days. On the daily chart, when we have a divergent high or low, Those signal trend changes, once that divergence is confirmed, especially when a break of support or resistance comes right around that time, those are those signal trend changes that last for typically for weeks, if not months. As we had down here at the divergent low, we had a divergent high right here. It was pointed out, and that was right before the Brexit. This divergence, as you see here on this line, can be viewed two ways. We have an extension of the divergence right here. This is really what I call double negative divergence. We had a divergent high here, a little correction, pretty healthy one, and a second consecutive divergent high, and it builds off there. So you can look at from this point, lower high on the RSI and a lower high. There's the MACD. There was our first divergent high right there, and so far we're still really right at that downtrend line. So if the S&P happened to reverse today or tomorrow, this downtrend line would hold here. But as long as it doesn't take out this previous reaction high back here, that's actually should be drawn like that. This was a series of divergences such as I had covered back here in Sunday's video. So 1, 2, now 3 divergences. And we can also look at it this way. Besides a series of building divergences from this point here, you can see here on the RSI, as well as right here, let's draw it on the MACD. There's your divergence. Now, I like to say, I use a term, this divergence is not confirmed. The MACD is a momentum indicator, is still clearly pointed higher. And so what can happen is if prices continue to go higher, first this previous reaction high will be taken out, negating this divergence right here. And then this larger divergence, should we go up above that reaction high, it will be taken out, and that will then really greatly hinder the bearish case. But right now, personally, I don't buy breakouts that occur on divergent highs. The other thing, I've pointed this out in the past a lot, when I have a chart pattern, whether you name it, any kind of pattern, a wedge, and prices have ramped up to get there. Or in this case, this was a horizontal support level. It was a well-watched level, these previous highs from 2015. And the move to get there, we had a run of, let's try to grab it here. So far, prices since that low just a couple weeks ago, the market's up 8.25%, and at the point of the breakout, it was up about 7.5% just to get there. Where I'm going with this is, although we're not overbought on the daily time frame, the RSI is only around 64 right now. We are overbought on the near-term time frames, the 60-minute and all that. So, in my experience, best case, this breakout will at least come in and backtest the highs, backtest that level that it recently took out, maybe go a little bit below it. Usually those backtests, if they're going to be successful, I'll see them come back in to kind of fake out the masses a little bit. So maybe we fall back below the 2015 highs. Here's a reaction high to watch. So at best, that's my expectation, that there was just too much fuel spent, if you will, to get up to that level for this breakout to just continue on like this and head right on up without at least a healthy pullback and consolidation. That's at best. And at worst, we're looking at a failed breakout. Again, very low volume, little follow through. And more importantly, now let's go into look at the other major indexes that I follow, the NASDAQ 100. Oh, I'll lock up here on the charts. Okay. I don't know, sometimes TC2000 freezes up when I'll load another chart. Maybe it's all the annotations. All right, this is a lot on this chart. Try to forget everything except what we're focusing on here. So what I wanted to point out, just as with the SPY or the S&P 500, this high so far in the NASDAQ 100, or the QQQ, which we're looking at here, is a divergent high. From this point to this point, prices are making a higher high, with both the RSI and the MACD making a lower low. However, they're what I refer to as unconfirmed divergences, because we need to see that MACD roll over before this high is taken out, before this previous reaction high right here is taken out. Or there's a possibility, just as with the SPY, we have these larger divergences in play here, going all the way back there. So from this point right here, well, we'll just take this trend line Ooh, messed that one up. Got a lot of lines on this chart. There you go. There's a larger divergent high. So that's why I'm not chasing this breakout on the long side. I'd rather sit back. If you're long, by all means, stay long and just raise your stops or be on the lookout for a failed breakout. You know, if you want to take a shot, if you don't have a lot of shorts or any shorts at all, and you want to short here with a stop on a closing basis, I need to mention that the Qs right now are at very significant resistance. They are at what I call refer to as the New Year's gap. I talked a lot about this. The New Year's gap was when on December 31st we closed right here on this candlestick, and then on January 4th, the first trading day of the year, we gapped down below that. And what I'm referring to, that being the trading range. Let's see if I have this big trading range here. So it almost appeared like an island cluster top. You had this range of candlesticks. We had a gap up that started this trading range, and that was highlighted at the time. We gapped down below it right here, back tested it, and boom. So this was a very technically significant level, this gap, and I've talked about it a lot this year. We came up, we entered the gap from below back here in April, came up, but fell just shy of the top of that gap, trying to backfill it, failed to make a full backfill almost to the top. We came back up in it again, what is that, in June, early June, and just entered the gap and rolled over. Now we're at the top of that gap, and I mentioned all the way back here, you know, and as we got here, this is where I'll call it a line in the sand where the short case is significantly hampered or damaged, or the bearish, long-term bearish case. I mean, the near-term trend, this market's been choppy. There's really a very near-term trend is up. The intermediate-term trend is indeterminable. We've been in a sloppy trading range for all year pretty much. We've had these rips and dips. So that's my thoughts on the market, guys. And it's not black and white. It doesn't mean if we go close above this level, and I'm looking at a closing basis. That's all I care about. If we close solidly above that level, that's where I personally begin to really, it unwinds the bearish case. It's not a black or white or all or none thing where if we close above that gap, that December 31st, the lows on December 31st, which were 111.84. So if we close above that, do I flip from longer-term bearish to longer-term bullish? No, not right away, but it does bring into question and really open the door for new highs in the NASDAQ 100. Other than that, the long-term case, everything that's been talked about for a while now, you know, the market topped back in 2015, and that's everything. You know, we went over this before with the Wilshire 5000, the Russell 2000, the mid caps. Everything right now but the SPY. SPY has made a marginal new high, and there's something, if I have time in this video, I'll cover that. Let me see here. Yeah, let's first just cover the IWM for those of you trading the small cap stocks. Here's the IWM. Also, same story. Significant level. We had a divergent high right here. Now we have another divergent high. It's only potential because you can see that MACD pointing almost straight up. So we have to have a reversal pretty soon. IWM is also at a pretty significant resistance level. It's this reaction high back from, I guess that's November 30th, 2015. We had a reaction high right here in IWM. It was a divergent high that preceded this big fall right here. The divergences are shown there. We had a divergent low. It's just like the S&P 500 chart I covered. You know, these divergences play out more often than not. However, this is only potential divergence at this point. And again, the purple lines here show you a smaller divergence, which is a series within larger divergences, just like on the S&P 500 and QQQs, just as we had here in all the markets, and SPY, the Qs, IWM, a series of smaller divergences, each of which played out, which really built up, culminating in this larger divergence right here, and that was the top, and that started a bear market in the small cap stocks. You can see the small caps drop by, you know, is at 27%, so well, easily a bear market. And is that bear market over? Was that enough? Maybe, possibly. Let's see if this breaks out, if these divergences are burned through. By burn through, I mean take out this previous reaction high, and then more importantly, the previous reaction high right here where the crosshairs are, and then these other highs back here. And that's possible. And if it does that, it will also have taken out this reaction high. So that reaction high, by the way, if you look back here, I had this target zone, initial target zone, and as the term initial applies, that means that's the first target of many when that breakdown occurred. That was probably from the breakdown off of this large wedge here. So this was a support zone before. Support zone or target zone, I list if there's two support or resistance levels in close proximity as there were here. So what we're looking at now, we're at the bottom of that former support zone, target zone, and that's where prices failed before at the bottom of that zone. We're getting a little bit into it right now, and we could push up to the top of that zone. In fact, that would make for a nice fake out too, just like on the SPY. The fact if we take out, which I guess we have now, let's see. Oh, we're right about there. I have to move this. Yeah, I think we've taken that out by a hair. So again, on face value, that looks bullish. However, if we fail that breakout, we move back down below. Look for some type of evidence of a bearish, some type of bearish reversal pattern, candlestick pattern, maybe an engulfing candlestick. And, on the bullish case, if we power on through there, these divergences are taken out. Maybe we come back, consolidate, retest this level around here, and then power back up, just like with the SPY, as I mentioned, a back test of those breakouts, and then to work off the near-term overbought conditions. When I say near-term, I'm talking the 60-minute charts and the intraday charts. Okay, to wrap this video up, there's something else that's giving me pause on this breakout, and I'm trying to piece it together. Something that's bothering me with the breakout on the SPY is the fact that it's hard to see where this is coming from. Now, I'm going to get off on a tangent here a little bit. I read an article recently, which I'll probably share that, post a link to that article, about changes in the methodology that S&P uses in calculating the S&P 500 index. And they've actually had quite a few changes which really misrepresent the performance of, they had a change, a couple over the last decade. And again, I'll post that article, and it may have something to do with the fact that we're seeing the index break out to new highs here, yet the sectors that comprise the index aren't breaking out to new highs. In fact, I think I only have one out of something like 10 sectors that comprise the S&P 500. I think 2 of those 10 or so are breaking out, and same thing with the top components. And so let's look at that real quick, and then we'll wrap this up. This is the S&P. This is directly from their site, the S&P Standard & Poor's. Here's the S&P 500. There's a sector breakdown, and these are, as you can see here, information technology is about 20%, very top heavy, financials 15, almost 16%, healthcare, and it goes down the line. So you have the bottom materials only about 3%. And I'll go over, if there's time, I'll go over the top holdings here. But let's look at the sectors. Now, I have a watch list that has all of those ETFs in there. And you know what I need to do here is move this to another part of this, another monitor here. All right, let's take a look here. And what I'll do is I'll click through these components. These are the tracking ETFs for each of those sectors. And I'll start with the top one, information technology. That's XLK. We're on all these charts will be a 2-year daily chart we're looking at. So here's 2 years of trading history. Here's XLK. It's just now challenging its highs, has not broken out to new highs yet. So the tech sector, which is the information technology, the largest component, has yet to break out to new highs, and so I'm not sure where the S&P 500 is getting that from. Here's the financials, XLF, well off the highs, and this is concerning too. Somebody made mention to me in a private message today, and I have these same concerns. The financials are severely lagging here. They're down almost 9% off the highs. They're moving up recently, but they're still not even near these previous reaction highs. They've got a lot of work to do as far as technically from the chart, a lot of resistance to try to get above. And so that's the second largest sector at about 16%, well off its highs. Now we go down, we drill down the line, we go to healthcare. That's number 3 at about 15%, well off its highs right there. You can see the highs back here in 2015. And this high, like a lot of other sectors right now, is a divergent high. So the bullish case, glass half full, that's a support level, pretty decent support, or I'm sorry, resistance level around 73.22. It's taken out. Did it on a divergent high, not yet confirmed, potential divergence, so just something to watch. But again, the case I'm making here is where these new highs are coming from. Maybe it's sector rotation, maybe it's the smaller components within there. Because again, you have to understand the methodology of the S&P 500, which gets a little complex on how they calculate the returns. And again, they've pretty much fudged the numbers, if you will, in recent years. For reasons which will be explained in that article, which I'll share. So what's next? Let's see, I think it's consumer discretionary. Yep, XLY. Challenging its highs, but yet to make an all-time high. So now we've already gone through the top four, which comprise, let's see, we were at 20, I'm looking at the other page, 20, 30, 50%. This brings us up to about 62, 63% of the sector weightings in the S&P 500 which have not made, which are either at or well below their highs. We can go down the line, and I'll do it quick because it really doesn't matter. We're getting to much smaller weightings. Now, XLP has been strong. XLP, consumer staples, it's only 10%, almost 11%. This is by far the healthiest of all sectors. It is out to new highs. Now, I did a video on this recently. We had a couple trades, one or two, and they might have been stopped out, but a longer term, both technically and fundamentally, and I'll make a case. I might even do a separate video or put up some other trade ideas on this, but I think this will be a great swing short opportunity, especially some of the top holdings on XLP. So I see very little upside left in that, and I think over the next year this sector will be down substantially. I think we're looking at a bear market coming up, but take that for what it's worth. Maybe not, but that's my read on it. So there you're at, and we can keep going, and I'll just hit on them quickly because we're getting down now to only 10% in industrials. Industrials, there's highs from back in early 2015. We've yet to take those out. So again, where's it coming from? This new high. Here's the energy sector, well off its highs going back 2 years ago. I mean, not even close. So we all know what happened to energy, and that's about 7.4% right now. Utilities, XLU. Let's click on that. That's the only other one that has broken out to new highs. We had Divergence. That Divergence was burned through. This might have been an overshoot. We'll see. But either way, the utility sector only makes up 3.6% of the S&P 500. So, where it's coming from, I'm not sure. And then finally, to round it out, there's telecom. Right now, currently challenging its highs, and then basic materials, which, as you can see, is well off its highs. So here you go. You have utilities and consumer discretionary or consumer staples up at making new highs. And I'll keep it. Let's see. Let's talk real quick on some of the top components, because it speaks to the overall health of the market. Here's Apple. This is the largest component of the S&P 500. Just it's the largest component of the Nasdaq 100. I mean, so far off its new highs. Apple's still well at its bear market lows. By bear market lows, yes, Apple has been in a bear market. The top on Apple was back in April 28th of last year. Stock has already dropped well over 30%, and it's not far off the lows. Microsoft, and again, I'm looking at the same page I just looked at, the top components. I'm going in order of the S&P 500. Microsoft well off its highs. It has a divergent low here. I point that out. So, you have to give it to that. I definitely wouldn't short a stock that just put a divergent low on the daily. In fact, that one, if you are bullish, this one has a way to go. Probably come up here and ultimately break out to new highs. So that one has some room to go. I'm not going to knock it, but I just want to point out that it's still way off its highs. ExxonMobil, well off its highs. But as of recently, it's been moving up. Now, this one has a very strong divergent high. It may have lifted, at least this year, it helped give some wind to the sales of the S&P 500. but not looking so good right now. J&J has been strong. J&J undoubtedly has helped lift the S&P 500 up, and as has General Electric. You know, that one did just break out to new highs. And there's Amazon. Amazon, I need to update that on that. That just exceeded the suggested stop when I was gone, maybe even yesterday when I was driving home. But a very powerful divergent high, and I have a very high degree of confidence that in the next year this stock is due for a significant correction. I'm talking, probably well in excess of 20%. Extreme valuations, and the charts confirm it. Daily, weekly chart, weekly divergence. We need to see this PPO confirm that divergence by crossing down. We almost had a crossover recently, kind of jumped the gun on the short trade because we didn't have that confirmed divergence. But if and when that PPO crosses over, bearish crossover. So those are some of the ones that have held the S&P up, but the rest are down. I mean, this is another top holding, Berkshire, still well below the highs. So, wanted to talk on one of the holdings in there because it's still an active trade, still yet to be stopped out. Facebook, this one's still off its highs, and look at this, back testing that wedge, the bearish rising wedge right now. And it had a very strong divergent high before it broke down from that wedge. So this one I still remain very bearish. Personally, I'm short this stock. And again, the best of patterns can be foiled if the broad market, if this breakout sticks and the gains are built upon. The old saying in Wall Street, all ships are lifted in the rising tide. So it's possible this pattern's foiled. But right now, I honestly don't see any reason other than the fact we're still above this downtrend line. This needs to go. When this downtrend line goes in Facebook, that will really kick off, and it needs to go on a weekly closing basis. All these were intra-week breaks, but we need to see a solid weekly close. And there's the divergences that help to confirm the longer-term bearish picture, and the fact that an impending break of this trend line is likely because we have these divergences in place there. Okay, that's long enough. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed, and again, I'll try to follow up with any questions or private messages as soon as possible.